Most W-2 earners think they have almost no control over taxes. You get paid, taxes come out of your paycheck, end of story. But that's far from the truth. At Tax Saving Experts, we've helped over 270 high-income W-2 employees save over $12 million in taxes in just the past 12 months. And one thing we see over and over again is this: most people dramatically underestimate how many completely legal ways there are to lower their taxes. Some of these strategies are simple, some are more advanced. And when the right strategies are actually stacked together, they can reduce your tax bill anywhere from $20,000 upwards to hundreds of thousands of dollars. In this video, I'm going to walk you through every major category of tax saving strategies available to high W-2 income earners. From the easiest wins almost anyone can start with to more advanced strategies wealthy, high income earners use to cut their tax bills and build a real long-term wealth. So let's start with the first bucket, the tax strategies that already exist inside of your job. Most W-2 earners think tax strategy starts outside of their job. They think they need a business, real estate, or some complicated structure before anything meaningful can happen. But in reality, the first layer of tax strategy is often sitting right inside the benefits package that you already have, starting with a traditional 401k. This is the simplest, most familiar move, and still one of the most effective. When you contribute to a traditional 401k, that money goes in before federal income tax. So if you earn $300,000 a year and contribute the annual maximum, you're lowering the amount of the income the IRS can tax you today. That is very real. It's an immediate win. Then there's the employer match. Now, the match itself is not a tax deduction, but it is still one of the easiest wealth levers available to you. If your company is willing to add money on top of what you're already saving, that is free money working in your favor, and too many people still leave this on the table. Then we move to the HSA. This is where things start getting much more interesting. The HSA is one of the most powerful tax accounts in the entire code because it gives you a deduction going in, it creates tax-free growth while the money is invested, and tax-free withdrawals when used for qualified medical expenses. That's a triple tax advantage. If your employer offers an FSA or a dependent care FSA, those do matter as well. Not every W-2 earner will use them, but when they fit your situation, they can lower your taxable income and reduce after-tax spending on things you're already paying for anyway. Then for some high earners, there are deferred compensation plans. These are not available everywhere, and they come with trade-offs and risk considerations, but when structured correctly, they can allow you to push income into future years and manage tax timing more intentionally. And then there's the mega backdoor Roth. If your employer plan allows after-tax contributions and either an in-plan Roth conversion or in-service rollover, this can open up much larger doors in tax advantage growth than most people realize. So the big point here is very simple. Most W-2 earners think tax strategy starts after they leave work. But the truth is, your first tax strategy decisions should begin inside the job you already have. And this is the easiest money to save. Yet most people still do not optimize it. But even if you max all of these out, most high income earners still feel like they're overpaying taxes. And that is because the next layer is where tax planning stops being passive and starts becoming strategic. A lot of people think lowering taxes is only about deductions. How do I write off more? How do I reduce this year's taxable income? And yes, that matters. But wealthy earners don't only focus on paying less taxes today. They also focus on building future money the IRS cannot touch later. And that's where tax-free growth comes in. The first strategy here is the Backdoor Roth IRA. High-income earners are usually blocked from making direct Roth IRA contributions because of income limits. But the Backdoor Roth creates a legal workaround. You contribute to a traditional IRA and then you convert it to a Roth IRA. And once that money is inside the Roth, it can grow tax-free for years. That means no tax on gains, no tax on qualified withdrawals later, and no required minimum distributions during the owner's lifetime for Roth IRAs. That's a huge deal. And if your employer plan allows it, the mega backdoor Roth takes the concept even further. This is where W-2 earners can move a much larger amounts into the Roth space through after-tax 401k contributions and quick conversions. When done right, it creates a very powerful tax-free bucket over time. And then there are the Roth conversions more broadly. These won't make sense for everyone, and they're highly timing dependent, but in the right years, especially lower income years or transition years, converting pre-tax money to the Roth can make a lot of sense. The reason tax-free growth matters for high earners is because the bigger your income and the longer your time horizon, the more painful future taxes become if all of your wealth is trapped in taxable or tax-deferred buckets. So lowering your taxes is not just about what happens this year. It's about what kind of money you are building for the future. And most people focus only on deductions. But wealthy earners focus on future tax-free buckets as well. Now, those strategies are powerful, but they still live inside a limited box. The next category is where W-2 earners start creating options that tax code does not normally hand to employees. This is one of the biggest mindset shifts a W-2 earner can make. Up until this point, you're still operating almost entirely as an employee, and pure W-2 life comes with very limited deductions. You earn income, you get taxed, and then you pay for the rest of your life using after-tax dollars. And that's why so many high earners feel like they're making great money, but not keeping enough of it. A legitimate side business changes that. It does not just create extra income. It changes which part of the tax code becomes available to you. Once you have real business activity, Section 162 comes into play. That's the part of the tax code that allows deductions for ordinary and necessary business expenses. And that is where things open up. Now, when I say a side business, I'm not talking about setting up a fake LLC hoping the IRS looks the other way. I mean a real, legitimate business with a profit motive. It could be as simple as consulting, coaching, content creation, niche advisory, a small service-based business, an online offer tied to your expertise, something real. And the setup can be very simple. Start with a single member LLC, get an EIN number, go open a business bank account, use a dedicated business card or credit card, set up basic bookkeeping so the records stay clean. That alone will create structure. Then once the structure is there, you can start doing things the right way. You can use an accountable plan to reimburse legitimate business expenses. You can keep clean logs, separate personal and your business activity. And when profits become meaningful later on, you may evaluate to make an S-Corp conversion, if it makes sense. But the key idea here is this: a side business is often the first major tax unlock for a high W-2 income earner. Because now, instead of paying for everything after tax, you create a path for certain legitimate expenses to be handled before tax. And once a W-2 earner has even a small side business structure, a whole new layer of deductions open up. And some of those deductions involve things you're already paying for anyway. This is the point in the conversation where people usually realize just how much they're paying for with after-tax dollars. Because once the side business is legitimate and the structure is clean, many everyday expenses suddenly have the potential to become real business deductions. Let's look at a home office, for example. If you have space in your home, you use it regularly and exclusively for business, that can become a deduction. And then there's internet and your phone. If part of your internet and phone use is tied to the business, that business portion can become deductible or reimbursable through an accountable plan. Then there's equipment, laptops, cameras, microphones, lighting, office furniture, software, AI tools, subscriptions. All of these can potentially be ordinary and necessary business expenses that are actually tied to your business use. Travel becomes another category. If the travel is for legitimate business activity, meetings, conferences, filming, education tied to the business, site visits, consulting work, there may be deductibility there. Meals can also qualify when there's legitimate business purpose and the documentation is handled properly. Education tied to your business can matter as well, from mileage, supplies, bookkeeping tools, platforms, additional advertising. Even paying your kids for real work can become part of the strategy when appropriate and documented properly. And on the more advanced side, you may hear about the Augusta rule, where under the right facts, you can rent your home to your business for qualified meetings and potentially create tax-efficient movement of money. Now, none of this means the wealthy spend less. Often they simply spend through better structures, and that is the point. This is the part where people realize how much they've been paying for with after-tax dollars. But side business deductions are only one path. Another huge mistake high earners make happens around something they're already doing every year, which is giving. Quick pause. If you're watching this and realizing there are more legal tax strategies available to you than you thought, that's exactly why we created our free school community to help you implement implement these exact strategies. You can join using the second link below. Inside, you'll get step-by-step guides, training replays, and Q&A support built specifically for high-income W-2 earners and business owners who want to stop overpaying taxes. All right, let's keep going. So most high earners think charitable giving is just generosity. And of course it is generosity, but it can also be strategy when done correctly. The problem is that most people give in the least tax efficient years. They donate cash every year. The standard deduction swallows up most or all of the actual tax benefit. And then they wonder why the return barely moves. That's where strategies like the donor advised fund come in. A donor advised fund allows you to separate when you take the deduction from when the money actually reaches the charity. So instead of giving smaller amounts every single year, you can bunch multiple years of giving into one high income year. That may allow you to itemize, take a much larger deduction in that year, still distribute the money to charities over time of your choice. It gets even better when appreciated stock enters the picture. If you donate appreciated stock instead of selling it first and then giving cash, you may be able to deduct the fair market value and avoid capital gains that would have hit if you sold it yourself. That's a very powerful move. And if you time those charitable deductions to big income years, bonus years, RSU years, unusually high income years, the impact can become much more meaningful. So the key message here is very simple. You do not have to give more to get a better tax result. You just have to give smarter. And this is one of the cleanest legal tax moves high earners can make. And while giving can help lower taxes, the next category can do something even more powerful. Turn assets into major deductions. Real estate is where a lot of high earners start paying very close attention because real estate does not just build wealth. When structured correctly, it can also create very large deductions. The core tax concept here is depreciation. The IRS allows owners of real estate to deduct the wear and tear of a property over time, even if the property is actually rising in market value. That alone is powerful. But when you combine real estate with a cost segregation study, things can get much more aggressive in early years. Cost segregation studies break a property down into shorter life components, which allows portions of the property to be depreciated faster. That accelerates deductions. Then, for high W-2 income earners specifically, the conversation gets even more important around short-term rentals, material participation, and real estate professional status in the household. Because by default, most rental losses are passive, and passive losses will not offset your W-2 income. That's the part most people miss. But in certain cases, especially with properly structured short-term rentals and real participation, those losses can become much more useful. Then you have placed in service timing, which matters enormously. If the property is not actually placed in service in time, the tax result may not hit when you actually thought it would. So the reason real estate is such a powerful tax tool is not because real estate lowers taxes in some generic sense. It's because real estate can create deductions, depreciation, and timing opportunities that become very valuable when structured correctly. This is where 5-figure and 6 and multiple 6-figure deductions can start to show up. But with more advanced strategies comes a bigger need for structure because none of those savings matter if the documentation falls apart. This is the part people usually want to skip, but they should not, because the tax code, it rewards strategy only if you can prove what you did. That means documentation matters. Separate accounts matter. Receipt capture matters. Mileage logs, they matter. Your home office proof actually matters. Business purpose notes, it matters. Reconciliation habits matter. And if you ever get a notice from the IRS, your ability to answer calmly and factually depends on whether the records are actually there. This is what makes the difference between a deduction that survives and one that disappears. So if you're running a side business, personal and business transactions should not be commingled. And if you're claiming mileage, it should be logged. If you're claiming a home office, you should be able to show the space and support the calculation. If you're deducting meals, there should be a record of who, why, and what the business purpose was. If you're using more advanced strategies, the return should tie back to the clearly sourced documents. The point is not to create stress. The point is to create evidence, because once the records are clean, April becomes much less emotional. And if a notice ever arrives, you respond with facts, not panicking. So now you've seen the major ways W-2 earners can legally lower their taxes. The final step is understanding how to stack them on one another. And finally, this is where everything comes together, because the biggest tax savings rarely come from one magic trick. They come from stacking legal strategies together in the right order. One strategy helps alone, maxing your 401 401k helps. Using an HSA will help. Doing a backdoor Roth helps. Side business will help. Using a donor advised fund helps. Owning the right real estate the right way helps. But when multiple strategies are layered together intelligently, the result looks completely different from the default W-2 experience. That's when real tax planning starts to emerge. For example, someone might combine traditional 401k contributions, HSA funding, a backdoor Roth, a side business with real deductions, a donor advised fund in peak income years, and real estate with strong documentation and timing. Now you are no longer relying on one tactic. You're building a system, and that is the real secret. The best tax plans are layered, not isolated. This is the point where most people realize tax planning is not a single tactic. It's a structure, it's a system, and a sequence. And if you want help figuring out what the system should look like for you, here's the next step. If you're a high-earning W-2 employee making over $300,000 a year and you want help figuring out which of these legal strategies actually apply to you and how to implement them the right way, then use the top link in the description to book a free tax strategy call with our team. And if you're not ready for a call just yet, join our free school community with the second link below. And remember, your income should be funding and building your wealth, not just funding the IRS.